If you receive the age pension and are considering selling your home to purchase another property, there are essential Centrelink rules you must understand before making any decisions. Many pensioners have genuine concerns about what happens when a large sum of money from a property sale lands in their bank account. Will Centrelink reduce or cancel my pension? How much time do I have to buy my next home? And during this transition, does Centrelink treat me as a homeowner or a non-homeowner? These are critical questions, and not knowing the answers could cost you significantly in pension payments. Before we continue, if you find this information useful, please take a moment to subscribe to this channel. We are dedicated to bringing you the latest Australian pension news and Centrelink updates in clear, easy-to-understand language. Your subscription helps us reach more pensioners who need this information, and it only takes a second. Thank you for your support. Now, let us explore exactly what you need to know about selling your principal home while receiving the age pension. In the current Australian property market, selling a home often means receiving a substantial amount of money. This can range from several $100,000 to well over $1 million in many areas. Under normal circumstances, if this money simply sat in your bank account, Centrelink would count it as a financial asset. This would be assessed under both the assets test and the income test through Deeming rules. For many pensioners, such a large amount suddenly being counted could dramatically reduce their age pension or disqualify them entirely. The good news is that Centrelink recognises this situation and has established a special concession called the Principal Home Sale Proceeds Exemption. This provision is specifically designed to prevent pensioners from being unfairly penalised when they are simply transitioning from one home to another. Here is the fundamental rule explained simply. After selling your principal home, the portion of sale proceeds you genuinely intend to use for purchasing, building, rebuilding, repairing, or renovating a new principal home can receive concessional treatment from Centrelink. Let me illustrate this with a practical example. Suppose you sell your home for $1,500,000. You plan to use $1,200,000 to purchase your next property, and you intend to keep the remaining $300,000 for other purposes. Under the assets test, the $1,200,000 earmarked for your new home can be exempt from assessment during the exemption period. However, the $300,000 not intended for housing is immediately treated as a financial asset. Under the income test, the $1,200,000 intended for your new home is deemed at the lower deeming rate, currently 0.75%. The remaining $300,000 is assessed using standard deeming rules, potentially subject to both lower and higher rates. An important technical detail is that the money set aside for your new home is assessed separately from your other financial assets. This means you still receive the full benefit of the lower deeming threshold on the rest of your investments. One crucial point to remember is that the exemption is capped at your actual sale proceeds. If you sold for $1,500,000 but plan to spend $1,800,000 on your new home, only the $1,500,000 can be covered by the exemption. Understanding the exemption period is essential for planning your property transition. The exemption period typically begins on the settlement date of your former home, when ownership transfers and you receive the proceeds. The exemption period ends when the earliest of these events occurs. First, when you settle on your new home purchase. Second, if building or renovating, when you move into the new property. Third, if you change your mind and no longer intend to buy a new home. Fourth, after 24 months have passed. This 2-year standard period provides adequate time for most pensioners to find and purchase a new property. However, extensions up to 36 months may be available in special circumstances, which I will explain shortly. A common question is whether you are treated as a homeowner or non-homeowner during this transition when you have sold one home but not yet purchased another. The answer is straightforward. Throughout the entire exemption period, Centrelink continues to assess you as a homeowner. This means the homeowner thresholds apply when calculating your pension entitlement. These thresholds are lower than non-homeowner thresholds, but this is balanced by the fact that a significant portion of your sale proceeds is already exempt from assessment. There is an important exception to normal homeowner rules during this period. Ordinarily, homeowners cannot access rent assistance. However, during the sale proceeds exemption period, you may still be eligible for rent assistance if you are renting while searching for your new home. The rent assistance amount depends on your rental costs. There is a minimum rent threshold before assistance becomes payable. Once your rent exceeds this threshold, you receive 75 cents for every additional dollar of rent paid, up to the maximum allowable amount. You may have noticed the word intention appears frequently in these rules. This is because the concession is based on what you intend to do with the sale proceeds. Only the portion you genuinely intend to use for purchasing, building, rebuilding, repairing, or renovating a new principal home qualifies for concessional treatment. Does Centrelink require proof upfront that your intention will happen? The answer is no. When you sell your home, you must notify Centrelink within 14 days of settlement. At that time, you declare your intention regarding the proceeds. Centrelink does not require advance proof. You are simply making a declaration of your genuine plans. What if the final purchase price differs from what you originally stated? If your intention was genuine at the time and you told Centrelink you planned to spend $1,200,000, but found a property for $1 million, Centrelink generally will not reassess or recover payments because you spent less than intended. Similarly, if you end up spending more than originally declared, Centrelink will not compensate you for pension that could have been higher. However, if your intention genuinely changes, whether planning to spend more, less, or no longer intending to purchase at all, you must notify Centrelink within 14 days of that change. In certain circumstances, the exemption period can be extended from 24 months to up to 36 months. To qualify for an extension, all of the following criteria must be met. First, you must have a continuing genuine intention to use the proceeds to purchase, build, rebuild, repair, or renovate a new principal home. Second, you must have made reasonable attempts to achieve this goal, such as actively searching for properties, making offers, or progressing building plans. Third, these reasonable attempts must have been made within approximately 12 months of the settlement date. Fourth, you must have experienced delays beyond your control. Examples include waiting for council approvals, prolonged illness or hospitalization, or widespread building industry delays caused by natural disasters such as floods or bushfires. Extensions are assessed on a case-by-case basis. If you believe you may need more than 24 months, contact Centrelink directly or seek professional advice about your specific situation. To ensure you receive correct pension entitlements, there are important reporting obligations. When you sell your principal home, notify Centrelink within 14 days of settlement. Include the sale price, settlement date, and your declared intention for the proceeds. If your intention changes during the exemption period, report this within 14 days. When you purchase your new home, notify Centrelink of the settlement date and property details. Keeping accurate records of your property transactions is advisable, including contracts and settlement statements. Selling your home while on the age pension does not have to result in losing your pension payments. The principal home sale proceeds exemption provides genuine protection for pensioners transitioning from one home to another. To summarize, money intended for your new home can be exempt from the assets test during the exemption period. Under the income test, this amount is deemed at the lower rate. You remain classified as a homeowner, but may still access rent assistance if renting. The standard exemption period is 24 months, extendable to 36 months in special circumstances. And you must notify Centrelink within 14 days of settlement. As individual circumstances vary, contacting Centrelink directly or seeking advice from a qualified financial advisor is always recommended for your specific situation. Thank you for watching. If you found this helpful, please subscribe to stay updated with the latest Australian pension news and Centrelink updates. Understanding your entitlements ensures you receive every dollar you deserve. Take care, and I will see you in the next update.